also known as Diamond Dave. And what we're going to kind of talk about is how to kind of understand what the options chain is telling you to put yourself in the best position to make profit. So there's not going to be a guarantee. And what this is going to be for a lot of people, this won't make any sense off the top because they haven't done like the preliminary work to understand what I'm talking about. And this probably should be something I should put in my course, but I'm just making this video real impromptu because this is something that's standing out. And then you may be able to take some of this and help you in your options trading, right? And so what I'm doing is I'm looking at Wayfair. Okay. Now let's just look at their chart. This is a company that I've made a good amount of money on puts recently. So this is just their yearly chart on the weekly, right? So we just see, it got around, let's say almost 350, 338, and it's just been selling off ever since. And then we see a really rapid decline around November, pretty much when the market turned really, really bearish. It's been selling off. Here is its pre-pandemic low was around, the pandemic low was around $30. Pre-pandemic trading range was around 106. So we're well under that. We're probably about half of that, right? They had a last earnings. Their earnings was not that great. And what we're seeing is a lot of revenue compression, a lot of revenue contraction, and a lack of growth. So this was kind of seen as a growth company because we see that they were trading around the 150 before the pandemic. This is like an at-home online retailer where you order stuff for your home online. Because of the environment, they shot up really, really high. They were kind of seen as a growth play. One of the challenges with this particular company, we see that the negative profit margin, they don't have a profit. Operating margin is negative. Return on assets is negative. Quarterly revenue growth is down. They got a decent amount of debt, but also got a decent amount of cash. They can half out their debt with the cash in the company. Operating cash flow, levered free cash flow is not that bad. One of the things you want to watch out for is that the float is 74. Shares outstanding is 79. Institutional holding is 112. So primarily what's been selling over these past few weeks have been institutions. But the issue is that they got a 45% of their float is being shorted. That is a massive short percentage, right? Almost half of their float is being short sold, right? So that's a massive amount of a short percentage, in my opinion. Looking at their financials, and one of the biggest things that shows up is that their operating income is negative, right? 2021. Trailing 12 months operating income is negative about $430,000. That probably will only continue to increase, which means that there's really no profit left in the company after revenue. So they're churning revenue, but there's no profit left, right? Which is going to impact their business over time, or they're going to have to do some type of dilutive situation, or they may be able, because they got revenues, they may be able to sell a bond. You never know. I don't know what kind of physical inventory they have, so they may not be able to do a senior offer unless they got some real estate that people may value to do maybe a senior offer against. So they could do an unsecured senior offer. You never know until you take it into the market, see what the appetite is there. And so what I am, personally, it's not investment advice. I'm still bearish on this particular ticker, really because of, I think that they're going to still deal with what I call revenue contraction on top of the fact that they're not profitable, on top of the fact that they're no longer a growth play. Okay, so that's my overall narrative. Now, they report on August 3rd, which is, we're in May, June, July, August, which is about 3.5 months away. What we kind of saw, in my opinion, a few days ago was, to me, a lot of short covering on this particular ticker. Let me show you what I'm talking about. 1 year, let's go to the 1 month. Okay, let's go to the 5-day. That'll probably show it better. So to me, okay, let me back out. What we're seeing like around here, because we got around to this 52, we came up a little, we got back around to this 60. What we're currently probably, in my opinion, seeing is some short covering. Even though we've fallen down really hard from, let's say, this 69.70, we sold down really, really hard. Got about to this $50 mark. And to me, what we're seeing is some short covering. What I mean by that is that shorts are starting to cover their bets. They're starting to cover their positions, I meant to say. And as a result, the price is starting to push back up to the $60 mark. We may get more of that in the future because of how this is sold off. So let's look at the 6 month. Because this is sold off so hard and we know that the short percentage is really, really high, we may get even more short covering. And what I mean by that is that shorts are going to cover. They're going to now go into the market and buy shares to cover their position because they might have shorted at 250. That can create a demand on a particular stock for that particular day, and it could drive the price up. And so what we've seen pretty much over the past 5 days is some upward momentum on the price, especially on the 12th. It came out, it was at a low, and it started moving up really, really aggressively towards $60. Short, to me, this is a short covering move. To me, this is also a short covering move, right? Now, that's not investment advice. That's just my own analysis. However, what I want, best case scenario, is for this to even move up even more. Best case scenario for me is this to get back to maybe 70 and then look to play it back down. However, these are the kind of things that you got to watch out for. And that's why I encourage people to really be willing to put the work in to try to figure out how to be successful at the market. So normally on Sundays, I spend about 3, maybe 4 hours just researching and looking at stuff, right? And this is really how I've been able to kind of lay the groundwork to be successful in these markets, is because I do this kind of work. There is no technology. There is no YouTube video that I watch. I really put the work in. And that's what I'm really trying to encourage people to do, is that it's like with anything in life, if you put the work in, a lot of times you're going to get a positive result. And then it just becomes an incremental, the result gets incrementally greater over and over and over, because you're doing the work that average person doesn't want to do. The average trader in this market, especially retail, is hoping that somebody on YouTube tells them what to do. And they can just play that, or they're in a trading group and somebody tells them what to play. This is the kind of work they don't want to do. And that's why I tell people, if you're in a trading group, most likely you're getting the value of that group at a discounted price, because somebody has to do this kind of work. It just doesn't come out of nowhere. So what I'm looking at is I was looking at puts to expire after the earnings, which I believe is in early August. Now, August 19th is a monthly option expiration, which means that it's when a lot of options are going to expire for that month. And if you look at this particular company, they got weeklies, and then they go into August and they just got a monthly. And it doesn't mean that contracts won't open up as we get more into August, because we see after June 24th, everything is just a monthly expiration. So August 19th is a monthly options expiration. Normally on those dates, you get a little bit more volatility because a lot of options are going to be expiring for that month. So all across the market, we're going to have options expiring on that month, because a lot of tickers, quiet as kept, don't have weekly strikes. They just have monthlies, right? So on the monthly expiration, this is something I talk about in the VIP course. You can also sometimes get a lot of volatility. So looking at August 19th, and one thing I see is that for calls at the 105 strike, and let me zoom this in so people can see it a little bit better. At the 105 strike, what I have is 24,000 open interest, right? So if I take, let's just say we take the 190 and we multiply that by 24,000, right? It means they got about 4 million sitting on that chain, right? That's a lot of money sitting on that strike, okay? Not including the 155 at 15,000, which is 60. So there's a lot of money. That's why I tell people that, like, the options game is not really a game played by retailers. It's really a game played by institutions, right? It's just people don't really understand the space. So their conversation is really on a retail level, but there's no retail that can put 4 million on an option chain, right? This is done by institutions, because this is not even what, a meme stock or really popular stock. This is done by institutions, right? So there's 4 million on this chain. Now, my question is, why it's trading at 58.64, it closed. Why is there this big of a position this far out of the money? Then why is there this big a position this even farther out of the money, right? But we know they missed their last 2 earnings, right? Now they have a lower projection for the August earnings, but we know they missed them, because even if they come in right at the earnings, right at the projection, it's still a lower estimate than what they had previously. So we see that their earnings estimates keep going down. My question is, why are people here? And what I'm seeing is that it's not equivalent. So it's not like a straddle on the other side where you get an equivalent on the same strike on the same date. That's not what's taking place. So if I look at like the 105 and the 115 here, I'm not seeing that on that open interest. Right now, what could be is that there's so much of a high short percentage on this particular ticker. Maybe short sellers are going to hedge against a short squeeze, because when you got a 45% short on a 74 million float, you can be set up for a short squeeze. So maybe short sellers are hedging against a short squeeze by putting a lot of money on this strike in case it squeezes, and then they can monetize the squeeze. That's just a like a hypothetical situation. Could be true, could not be true. However, this is a lot of open interest on this ticker, and you see there's nothing really under it, right? And then there's also here, and there's nothing in between here. So it's not like an Apple where you got open interest all up and down the strikes. That's not this kind of ticker. And these are the kind of questions you want to ask yourself when you're looking at options chains. And this is why, there's no technology. The technology can tell you that this is here. Like, you can get technology to aggregate all these chains and tell you which chains got the most open interest, but it won't give you scenarios as why it could take place. So, you don't have to pay for the technology. You can just sit here the same way I'm doing it and just go through your chains. And this is the type of stuff I used to do before I even started buying people's technology. We're also seeing this here on the September 16th. There's 3,000 at the 150, right? Now, this is a little bit more balanced on this chain because we do got something on the puts. However, it's just unusual to me to see that much open interest way, way, way out of the money like that. That's kind of weird. It kind of stands out. And I'm not going to draw a conclusion of, oh, well, it might mean this. No, I'm just wary of that because it doesn't make a lot of sense for it to be that far out of the money. Because the problem is that as we get closer to August 19th, this contract's going to start losing a lot of premium really, really rapidly because of implied volatility, right? Not being able to hit this particular forecast. So IV is 91%. As we get closer and closer to August 19th, this is going to start decreasing in premium really rapidly because why? It's not going to hit the volatility forecast because why? It's so far out of the money, right? I would never buy this contract this far out of the money with it trading at these prices unless I knew something. But other than that, I would never buy that. Definitely wouldn't buy this contract. This is too far out of the money. It's going to be 155 by August 19th. And really, I wanted to be higher than that to make it worth me buying these shares at 155. And also, it got to hit this volatility forecast. So we would need a massive move up to 100, probably by maybe mid-June, for these contracts to not start losing a lot of premium because it's going to be a lot less likely for it to hit 100, 105, much less 155 by August 19th. And so these are the kind of this is the kind of research I do. If people want to kind of get a peep into the kind of research I do, the kind of questions I ask myself, because I still am bearish on this particular company. However, I hope that short covering pushes it up to maybe 70 to create more room on the way down for it from a bearish standpoint. Because right now at was 58 is not bad. It was, I think, at 40 something. There's not a lot of room because, I think this thing probably trades in a best case scenario around maybe $35 to $40, right? Over the course of this next year, maybe a little bit lower. Therefore, I want upward movement to create more room between, that 35 and 40 and where it's currently at. Right? So that's pretty much going to be the video. I want to encourage everybody. There was a sister that commented on one of my videos. She talked about how the man that she's involved in a relationship with is getting really good at kind of understanding where the market is going. And so I just want to really encourage people to just stay diligent in their research and their study in your own lane. You don't have to look at the market the way I look at it. You don't have to trade the way I trade. But I just want to really encourage you to stay diligent in your study and your application in your own lane, because that's how you're going to get the benefit, right? These markets are not like something that you can't wrap your head around. You just have to own the responsibility of getting your own understanding around it and then applying that understanding to the market, testing your analysis, finding out whether or not you're successful, and keep repeating that process until you get the success that you desire, because the results are really, really beneficial to you. because of we've been educated a certain way about how these economic systems work and about opportunities for yourself. And it doesn't really work the way in which they've educated us. It works a little bit different. And it's not a secret. It's just we just didn't know about it. If you got any questions, hit me up in the comments. But I want to really encourage you, be willing to do the research. Unless you're going to pay somebody at Goldman or you're going to pay an analyst thousands of dollars to give you the information, be willing to do the research, because somebody somewhere got to do the research. It doesn't just come out of anywhere. It definitely doesn't come out of a computer, right? Somebody somewhere has to do the research. If you got any questions, hit me up. David W. Williams, also known as Diamond Dave. I'll talk to you later.